One of the things that I like about the small account strategy, part of it is going to be based on market conditions, right? I mean, that's the reality of trading, guys. You're going to have markets like right now, it sucks. I mean, it just does because there's no direction, and if you get a direction, it goes for like a day, and then it changes direction. So, it's more a matter of strategy, and the reason that I like it is allowing you to trade without stops in volatile markets. This is a volatile market in that we get a lot of unpredictable volatility. I don't even like to call it volatile. It's a choppy market, and there's some difference in there. You can have a choppy market with no volatility, which is kind of what we've got right now, but people will call it volatile. You've got a market that you don't get clear directionality, and as a result, this strategy allows you to play the market without violating your risk rules and still have the potential to profit. And the reason is that we're going to buy an option for $200, and we're just going to let it do whatever it's going to do. And through the week, while everybody else is like, oh my God, this market is terrible to trade, I can't freaking figure it out, I don't know what it's doing. On day one, our position might go down. Well, normally we'd get stopped out here, right? But we don't, because we stay with this position, because $200 is all we have at risk in this, and a $10,000 account, that's an acceptable amount of risk. The next day it might go up here, and then the guys who got out yesterday are mad, so they get back in. They're like, that sucks, I got to get back in. And we're looking at it going, whatever. I mean, it's $200. You probably aren't even looking at this one anymore. You've moved on looking for other opportunities. Third day it might do this, and people in the market are like, well, crap, now I got to get out again, where we would normally get out there. We don't. We stay with the position. And then if the position goes up, we just let it run and then begin to look for those technical exits. So I don't know that I have an expected rate of return. We're just using this to follow the premise and the precept that good trading generates good profits. Trading for profit generates no profit because it's not good trading. The whole idea that if we let our winners run and cut our losers short, well, this, by default, the loser is cut short at $200. And by extension, we're just going to let the winner run until we find the technical reason for the exit, a cross below moving average, run out time, whatever the case is. So this becomes a strategy where I can participate in letting the winners run if I have a winner, and cutting the losers short because of the very limited amount of capital I have at risk in the entire trade. So what's my rate of return going to be? I got no idea, because I'm going to trade this from underneath, not from up above, right? One of the things that just, and I see it all over the place, and it's marketed all over the place, and I've met some people who are reasonably successful trading this way, where they're like, if you get in here, you got to know exactly where you're getting out. So we get in right here on the bounce, and then we get out as soon as the stock gets up here, right? And never mind that it freaking runs for the next 4 weeks and goes up another $125, and they're like, yeah, but I'm happy with here to here. Well, then you're an idiot, all right? I mean, I'm sorry, but that just, if you're happy with this little bit, you're not understanding what else is out there for you, right? Do we tighten our stops here? Yes, absolutely. But I would rather trade it from underneath, tightening my stops as we go, than to limit myself to, oh, I only want from here to here, right? I'm not going to get greedy. Bull crap. That's not greedy. That's just good business. Okay, so I don't have an answer. I don't know what the expected rate of return is. I would expect that, well, let's just go here for a minute. I'm going to say that a blind squirrel find a nut every now and then, right? And that 50% of our trades should go to at least a 3-to-1 reward to risk ratio. So think of it as a bell curve, right? So we're going to have some losses. We're going to have, 50% of our trades are going to go, to, so half of our trades would go to 3-to-1, which would be here. Right, so our 3-to-1, all right, it might be somewhere, actually somewhere on this part of the curve here. and then a very smaller, substantially smaller number of our trades might go to 4 or more to 1, right? And then we'll have losses or less than 3 to 1 on both sides of the curve. So we're going to have a distribution, if you will, of profit loss. But let's just say that 50% of our trades go to a 3 to 1. So we do 10 trades, we lose 200, and then we're going to make on the others, call it a 3 to 1. So you're up 600 on each one of those, right? Well, then it doesn't take a degree in mathematics or statistics to figure this out. But obviously you're going to be making more, and the nice thing about it is I'm using a 50-50. We know in all likelihood that you're probably not going to be 50-50, although I will say this: the thing about this strategy is that it takes a lot of the emotion out, so you have a much better chance of being at that 50-50 or better, because your emotions are taken out. You're not likely to do something stupid. I said likely, not likely to do something stupid like get out of the trade too soon. Right? You've got one contract in here. You're like, it's a freaking one contract. I'll just kind of trail this thing with a moving average stop, or I might not even look at it. I come back on Friday, I'll be like, oh, let's see how it worked out. Right? Got to let the winners run. But if you do on a 50-50 here, you're losing 1,000 and you're making 3,500. Well, that's a pretty good week, right? What if these numbers start to change? What if well, all right, let's take a look at it. Now you're wrong more often than you're right. Right? So you're losing 1,200, but you're making 2,400. Well, what if it's rough week, right? Things, you suck at it. Really good at picking the wrong ones. And, out of all the trades that we do tomorrow, the next day, the day after that, 1, 2, 3, 4, 5, 6, 7 of them go against you. You're losing 1,400, and you're making 1,800, right? You're wrong 70% of the time, assuming the others go to at least a 3 to 1 return, which I think is a reasonable assumption given the stocks that we're trading, and we'll see over time. Now, here's the thing: this might be 1 week of trading right there. That might be 1 week. Well, that's not going to tell us anything, right? What if we have 2 weeks? Well, that ain't going to tell us nothing. What if we have 3 weeks? You just, over time, we've got to see where this develops out. I can tell you that because you're removing the emotion, in my experience, you begin to approach 40, 50, 60% or better right to wrong or profitable to loss, with your profitable ones reaching as a target the 3 to 1 reward to risk target.